There has been a lot of manipulation in the tech sector, the overall market, and Navitas is not exempt from this manipulation. I've had a lot of comments, concerns, questions about this trade saying it was a bad call, a bad trade. We are all in this together, and this is just yet again another example of pure manipulation. Just like I told everyone, Meta calls would be fried on November 21st. They would sink the stock, then they would sell puts and the stock would fly, and they would take advantage of you, I, and everyone else by selling put options when we thought it was going to go lower and frying them on the way up. And that Meta would run the day after the November 21st calls. And if you look at a chart, since the day after that, the stock has been running just like I said. And I also told you this past week to watch by Thursday, the market would move, and it did. So I'm here to help you with Navitas and explain to you why this is not necessarily a bad play, just a rough time and a lot of manipulation going on. Let's think about Enphase Energy and Wolfspeed. Right now, we're in the tailwinds of this company, and they have shifted from the consumer market into the server and, of course, the data center space, which is great because they're partnered with NVIDIA. They're not profitable right now, but not every company starts out profitable. In fact, almost none do. So I want to break this down for you guys and why this is a great company to own. And I'm going to show you how to fix the current situation you might be in, how to dollar cost average, because if you had been dollar cost averaging the right way right now, you would be break even or in the green potentially. So I want to show you what you're doing wrong. So I'm here to show you how you can potentially fix this dollar cost average, show you why it's still a good stock and why I'm still bullish on it going forward. And I'm going to show you everything that you need to know about Navitas right now. Navitas is not just another chip stock. It's the vital power delivery architect for the AI era, following a high conviction, low margin now playbook reminiscent of early stage success stories like Wolfspeed and Enphase Energy. During their pre-profit transformations, while the company currently grapples with narrow profits and price to sales ratio exceeding 40, these metrics are trailing indicators that fail to capture the massive structural shift of Navitas 2.0. By pivoting from a low-margin consumer chargers to high-voltage silicon carbide, gallium nitride solutions for AI data centers, Navitas has secured a Tier 1 seat alongside NVIDIA at the table, powering the next generation 800-volt architectures that are physically necessary to support the 1,000+ watt processors of tomorrow. Much like companies that traded on the future dominances rather than the present earnings, such as Microvision or Universal Display during their initial growth phases, Navitas is being valued for its critical intellectual property and its status as an AI factory enabler. The bullish case hinges on a projected $2.6 billion annual market by 2030, where the shortage of energy efficiency in hyperscale data centers becomes a $1 trillion bottleneck that only Navitas high-density power ICs can solve. For investors, the current lack of accounting profit is a secondary concern compared to the company's ability to turn 40+ data center design wins into a reoccurring revenue engine that is forecast to rebound sharply as the second wave of AI infrastructure fully scales. I have put out a lot of calls over the past year and a half, so I just want to clarify so you guys can see my true track record here, and you can go back and watch any of my YouTube videos for timing. I called AMD at 105 and 110. Look where it is now. I called Palantir at 15, 30, and 50. Look where it is now. HIMS at 10. Robinhood at 16. Wayfair at 30. Affirm at 25. Ford at $9. I also called Rivian when it was $8. Serve Robotics when it was $6. Navitas when it was $6. Applied Digital at $7, $8, and $12. I also told everyone to buy Microsoft at $380, and of course Meta at $400 when the crash happened back in April and May. Let's not forget about Snowflake at $150, Upstart at $25, Nebius at $30, Shopify at $100. All of these stocks have had a 50%, upwards of even 200 or 300% return or 400% return in the past year to year and a half. I've had a lot of stock picks that have done well. If you have not done well with some of these stock picks, it's because of your timing, your entry, your exits, and your dollar cost averaging. You can't put all of your money into one stock and expect it to just keep going up forever. And I'm going to show you guys exactly what I'm talking about on a chart with Navitas, because on Serve Robotics, it's the same thing for me. I got into Serve Robotics at 14, then I dollar cost averaged at 12, 10, and even lower. And now I'm $1.50 in the green, thousands of dollars in profits. You cannot just buy stocks in large percentage amounts in comparison to your account size and over leverage and just hope the stock keeps running. And that's exactly what everyone's doing. You're buying at the top and not dollar cost averaging because you're putting in too much on the get-go and then it drops. You cannot go all in more than 10% on any one stock and just expect it to go up forever. Now, you could buy one time on a stock if you plan on holding a good company for years, but you can't get into a company like Navitas and just throw half your account at it at $14 and expect it to just keep going up. This is not how this works. I'm going to show you guys exactly what I'm talking about, how my students are making the profits that you're seeing on the screen right there, and how we've made money on Navitas. And I teach this in Discord. There is a rule book that we follow so that this doesn't happen, but I'm here to help you and show you why this is going to be okay, most likely, and why this is still a good company and I'm bullish on them. Let me show you exactly what's going on here. We've been down this road before in Discord with other stocks, and we're going down them yet again. And with this particular stock, I'm going to show you guys exactly what you should be doing. I first called Navitas when it was $6, so even after the dip, when it went down to $7 back on November 21st, you still would have been in the green. If you bought at the top before earnings, you have to understand my rules. You don't put more than 10% of your portfolio into any one stock. So if you put more than 10% in Navitas at that time and you're in the red, this is the reason why. You also dollar cost average. But if you can't dollar cost average because you put more than 10% in your portfolio in Navitas, well, then that's the problem. And if you don't know how to dollar cost average, then you shouldn't be buying these stocks. This is how it works. You must dollar cost average. You must understand the company. You must be below 10%. If you follow these rules, you will be okay. And let me show you what I'm talking about. Let's say you bought 100 shares of Navitas. All right. We're going to do that right now. 100 shares. And let's say you bought them way up here where the stock was $15. Okay. 100 shares times $15. That's 1,500. Well, the stock consolidated and dropped, and there is some resistance here, okay, which I wouldn't have dollar cost average there because I need to see a break of structure. And when you see this big red candle coming down right there, there is no break of structure at all. That's the structure up here. So it resisted, comes down. When it drops right here, we can see these candles and we can see the break of structure. This candle comes up and it's above this structure. And what I mean by this, there was no structure here because it's one big candle and it failed to break halfway through. Whereas this candle broke these red candles, which now breaks the structure. And even if you were to wait to the real break of structure, secondary one, which happened right here, you would have averaged at 880. Okay. So let's say you did that. You averaged at 880. What you would have done is bought 200 shares, potentially more, but we'll just say you bought 200 or 300 shares here. So we're going to add 300 times 1,500 plus 300 times 8. It would have been right about maybe 870-ish, just as an average. This would have given you this total amount right here for 400 shares, okay? So now you divide this, 4110 divided by 400 gives you 1020. So the stock's pushing $9, you have an average cost of $10.20. You're only out by $1.40 at this point. So the stock comes back up, and when we see this big resistance, we know, or at least if you know technical analysis, you know that it's coming back down. So we wait. It comes all the way back down. When it bounces here, and we see another little green candle, and it comes back up and breaks structure right here, this is another opportunity to add another 100 shares. So we're going to do this. 4110. We're going to add maybe another 200 shares. And the current price right there is $7.75 or maybe $8 flat. So we'll do like $7.80 just to be a little bit more modest. Then resistance comes back down. No break of structure because you see structure's right here and it's below. We see it break structure right there on a big green candle, but you never buy in a big green candle. It resists, consolidates, drops yet again. We get another scenario here. It comes back up and it doesn't break structure, but right here it does. So we add another 200 shares at $7.87. Okay. So we'd add another 200 shares at let's say even $7.90. What we would do here is we would now add another 400 shares to the original 400 shares. So we divide this by 800. So our average cost is $9.06, and now the stock is $9.48. And we have 800 shares. So 800 shares times about 48 cents roughly, you'd be almost $400 in the green. If you don't understand this method, then I implore you to study and get better, because I'm here to help you. And this is what I've done, and this is what my students do, and this is how you turn a loss into a win. You cannot just throw money at a stock while it's on the rise, expect it to keep going up and never go in the red. This is how you turn losses into wins. It's not too late at this point. Even if you have, let's say, 500 shares or 1,000 shares at 14, okay? 1,000 shares at 14 plus the current price of 948 times 2,000 shares, it's 32,000 divided by 3,000. This would still give you a 1098 average. You're only $1.50 out instead of $6 or $5, $4 away. So this is something to think about. Although I would not put that much into dollar cost averaging per se. Depends on your account size. There's a lot of resistance here. And it did break structure on this line right here. Meaning Navitas is likely, with this bullish market that we're transitioning into, likely to consolidate in between $9 and $10. So this could be the potential time to start adding a little bit now. When it breaks the next structure up at 1050, right around here, and pulls back, then you add a little bit more. You could get your average down into the $11 range and not be too far out. This is how we take advantage of this, but we're all in this together. And this is just another manipulation tactic by the market, because if you notice, Navitas tanked all the way down here on November 21st, which is the same that Meta did. Look at this graph that I drew on Meta, this line showing you the directional bias of Meta, and it's literally done just that, more manipulated than I even thought. $50 million went into one specific call option in dark pool for November 21st. They fried it on November 21st. Look at this right here, November 21st, and it ran the very next day. This market is manipulated. That's what they do. They want to shake you out of stocks like Navitas by putting out bad news or emphasizing bad news we already know and making it seem worse and fear-mongering. When they do things like this, it makes you sell, it makes you panic. And when you do this, it opens up more shares for them to buy. And then when it runs, what are you doing? As soon as the stock runs on good news, whether that's a month from now or 3 months from now, you're not in. You're trying to re-enter. So you sold the stock at a loss at $8 or $9, and then when it's $15, $16 again, you're trying to buy. I know this for a fact. You're always selling when things are tanking and buying when they're running. This is bad psychology. I'm trying to help you. We were all in this stock when they manipulated it down. The difference is I dollar cost averaged my position and increased it by dollar cost averaging and lowering my price. So now my average cost on Navitas is well below $9. So I'm in the green, and a lot of my students are as well. And then when the stock runs to 11, 12, 13, even if that's a year from now, we're in the profits. This is how we do it. And I highly encourage you to understand what I'm trying to explain to you in this video. Navitas may not be profitable and printing lots of money right now, but nothing has changed with this stock other than their direction of where they've narrowed it down to server data over the past couple of months. The market was 50% or more of the reason why the stock went down. The manipulation also plays into that as well. And the fear on Navitas, which was the fear that they put out there and the negative they put out there on Navitas to us so that you would sell. Because when interest rates get cut in the next couple of weeks, which they're highly likely to do so, money market and SPACs account money is coming over into the stock market. And you can bet this is just another one of those stocks they're going to put money into. And if you're not in it, you're going to miss out on the move. And this is what they do. You buy in at $12 or $13 or $14. They tank it to $8. You sell off. They bought it up and drove it back up to $9. And now you might sell it break even and it'll go up even further. And then you're going to be missing the move and trying to buy back in. It's manipulation. This stock, in my opinion, is very bullish long term. I think everything will be okay in it. That's why I have a position in it. I would breathe and I would focus on your psychology and understanding the dollar cost averaging that I've showed you on Navitas right here, and why this stock is very likely in the next couple of months to hold into the $10 and $11 range. And if you're dollar cost averaging, you could potentially get very close to break even, maybe even break even. Heck, you probably, if you've already been doing it, have a very good opportunity to be in the green now or very very soon. This is not something that I would necessarily give up on right now. And I can understand that everyone who bought the stock and it tanked after earnings, not good because of the manipulation and because of these analysts playing games with other people's money. It's what they've been doing a very long time. But you have to look at this. When in doubt, zoom out. When you look at this chart, if you got in here, Navitas is right here. It's already moved almost in this range right here. Almost half of its downside has been recovered. Its upside was 1350 and its downside was 690. Okay, 1350 take away 690 is 660. Divided by 2 is 330. 330 plus 690 would be 1020. We're about 50 cents away from half recovery already. And it's only been a month and a half, 2 months. So I would really, actually, it's been only 6 weeks, barely 6 weeks, and it's recovered halfway. And with interest rates getting cut, that'll send euphoria to the market, buying to the market, and SPACs money, big hedge fund money, all coming over from money markets, billions of dollars. And if this happens, then it would not shock me to see Navitas fighting and consolidating in the mid-10s, maybe $11 range. But I'd say high 9s, low 10s, maybe even mid-10s in the next couple of weeks to a couple of months. Very, very likely. But we have to watch, because as long as no negative news comes out of Navitas and no more manipulation and things stay the way they are right now and the market starts recovering like it is, Navitas is likely to follow that trend as long as nothing else negative comes out on Navitas. So this is something to think about, because now the stock's going to be consolidating into the bottom of my AVP, which is what I teach in Discord. This is very powerful, and the stock is consolidating along the bottom of this now, as we can see right here. Once it breaks above 965 and comes back and retests, we want to see something such where it comes up, comes back down, consolidates, and pushes up like that. This bottom area, 960 to 965, could potentially be the ceiling turned into the floor for Navitas. That's the prime metric I'm looking at right now. And once it holds that 970 and starts pushing up, when it's in the high 9s, low 10s, it has a very strong potential to move forward like this. Now, it could be like this, or it could be like this, or it could be down like this and then up. But I don't see much of that, although it could happen. I don't see that opportunity in the market now, with things going from extreme bearishness, extreme fear, to neutral. The fear and greed was 5, extreme fear. Now it's pushing 40, which is fear, and only a few points away from trekking into the outer perimeter of neutral. So this is what you guys need to understand. The market was at its all-time greatest fear, greatest sell-off over the past 6 weeks, and Navitas barely broke $7. So the chances of it going much lower than $9 now while the market's coming up is drastically lower and very unlikely, as long as no negative news comes out in Navitas and as long as their next earnings is not too bad. I would expect the stock to consolidate and slightly move up into next earnings. And if next earnings is good, the stock is going to move upwards even more. If it's a good earnings and the market gets the interest rate cuts and things keep going the way they are right now, and this week and next week and going into the new year is what I think it will be, Navitas should be in the $11 range by spring. And when the earnings happen, if they're good, it could even be $13, $14, $15, especially if they crush earnings. But realistically, if you bought up here, all this manipulation, taking advantage, lying, and manipulating the market like they always do, it has come down and it's still back up here. And if I take away all these drawings to make it easy to see, it came down, but now it's back up here. So if you had a bought down here after buying up here, your average would be somewhere right here, and you would not be far from breaking even. And if you had a bought more down here, then your break even would somewhere be in this area, like I explained. You should potentially be dollar cost averaging even now because of the price. And if it drops any more down here and starts consolidating, first break a structure, add a little bit more. But remember, no more than 10% of your portfolio, any one stock or one position. You must be safe. And like I've been telling you guys, I'm here to help you. This was a manipulation game they pulled on all of us, including Meta. And we're all in this stock, including myself. I believe in this stock, and I would not tell people to buy something that I don't own or that I don't believe in. I don't push stocks that don't run, and I don't push stocks that are not good. Every stock I've called has run. If you missed the move, I can't control that, fam. I'm trying to help you. But every stock, if you go back at the beginning of this video, rewatch it, all the stocks I called, and you go back and look at a chart, they all ran. Every one of them, every last one of them. Even when they went in their dips, if you dollar cost average, they would have went up again and you would have made more money. And that's just how this works. You can't just buy at the top and hold unless you plan on holding long term. Hopefully, I've helped you guys understand this. If you are confused by this and you want to learn more, I would love to show you the power of dollar cost averaging, my AVP, my D-Stochastics RSI, my DFib, and showing you how to use technical analysis to buy the bottom. And if you're not in the bottom, use technical analysis to dollar cost average to increase your position and lower your cost. If you'd like to learn these strategies and have access to me asking me questions and a community that is just like you and I trying to grow their portfolios and learn and live a better life, I would love to have you in Discord, coach you and teach you the right way. The link to get started is below. It's how we're making the profits you're seeing on the screen right now, and is how I am up in the green. And you can see my position right there on Server Box. I dollar cost average from 14 down to $12 and lower, and I am in the green. It's just one of the many positions I've taken just so I could show you an example of buying the top and dollar cost averaging and how it works. And you can see how I've done that right there on the screen. So if you guys would like to learn how to do all of this the right way and me to teach you the psychology, which nobody else teaches, the link to get started in Discord is below. I look forward to seeing you on the next one, and take care of yourselves, fam. We'll see you soon.